Thank you for joining us, guys, at the Reinmuth Team Podcast. We have with us today Rick Ward. Rick Ward is an amazing lender here in town in Colorado Springs. He is the guy that you go to get money to buy a house. He is the guy that you go to refinance. Whatever you need mortgage-wise, he's the guy. If you're military and you're wanting to purchase a home and you're stationed here in Colorado Springs, he works with Benchmark Mortgage, and he just kills it, man. He knows everything about loans. So we're going to have a discussion today with Rick. Find out. Rick, tell us a little bit about yourself. How did you get into, I know that you served in the military yourself. How in the world did you decide, I mean, I know that you weren't growing up when you were a kid going, hey, I'm going to be a lender when I grow up. I'm going to be a mortgage lender, right? Nobody says that. You somehow just get into it. Tell us a little bit.
Yeah, sure. So when I left the service, by the way, that's what brought me to Colorado Springs. I was stationed at Fort Carson. And then when I got out of the service, I needed a job.
Yeah, right, yeah.
And I was a cavalry soldier, so I was a helicopter crew chief.
Okay.
Trying to find a job like that in Colorado Springs is very limited. And my wife and I wanted to stay here. It's beautiful out here. So I ended up getting a sales job, and I worked for a big company called MCI.
Oh, yeah.
Yeah, here in town. And then, over the last, I would say, probably a period of 15 years, I was there, and I did some software sales for Oracle, another big company.
Yes.
Traveling quite a bit. My wife's like, you know what? You're on the road an awful lot. I need you to find something where you can stay home a little more. Kids were doing sports and stuff, and I'm like, okay, no problem. So anyway, I ended up getting in the lending business. That's kind of what propelled me into it. A guy that I used to work with at MCI, it's just, he was in my ear all the time. For 15 years, you got to get in the lending business. I'm like, I'm not doing that. I got a mortgage. I don't know anything else about it, right?
Yes.
But I made the transition and I never looked back. And it's been an awesome career for me and my family. So
awesome journey going through that, and you get to see people's excitement. Like you get to hand them the money to purchase their home, right? I mean, it's so rewarding to do that.
Very rewarding.
Yeah.
I mean, when I was in sales before, whatever I was selling, it was like a commodity. It was like,
sure.
And there's something about when you're helping someone secure like a place where they're going to be putting their kids to sleep, right? And, and somebody gets deployed, right? They want to know that their family's safe. So there's very rewarding to us to serve.
Yeah. Tell me about today and the interest rates. Everybody's kind of freaking out right now. Like, hey, I can't do anything. I can't buy a home. It's cost too much. Tell us, where do you think things are going right now?
Yeah. Well, let's address that concern, right out of the gates here.
Sure.
So I think over the last 2 to 3 years, we were spoiled because rates were historically low.
Yes.
I mean, they were, in the twos, right?
Right.
On average.
Right.
And so when you see that, the average consumer, when they get used to that or they just hear that in the market, and then all of a sudden, the federal government, which was very slow to respond to everything that was going on, and not to mention all the trillions of dollars they were spending, we started to see that inflation just accelerate at a rapid pace.
Right.
And so what the Fed does to try to combat that typically is they adjust that, what they call that Fed's fund rate. That's the rate that what they loan money to other banks. And it was at zero for the longest time. The government artificially stimulated the economy because of the pandemic. So as we're pulling out of that pandemic and they weren't kind of keeping their finger on the pulse as closely as they should have, then all of a sudden they had to ratchet up those rates really fast. We saw rates go from 2s and 3s, well, actually in the 3s, the beginning of last year, and then by June and to the last stretch of the last year, they've more than doubled, right? In some scenarios. So what typically happens is the rates will follow the inflation rate. So as inflation was coming up, rates had to come up because that's what they use to try to calm the economy down and get people to not spend money, right?
Right.
Too many dollars, chasing too few goods, right, or services. And so as the Fed raised that and rates went up, now we're actually starting to see that whenever you hear the government talk about, hey, inflation rates and, where's that core CPI they talk about a lot, what they're talking about is a 12-month, what it's been on average for the last 12 months. Well, as every month we get further into this year, we're dropping off a month from last year that was really high inflation rates. And as they've raised those interest rates and the inflation's coming down, then now that average is going to come down because you pick up a lower inflation rate,
Right.
and you drop off a higher inflation rate. So that index is going to come down. And as that comes down, interest rates have a tendency to try to follow inflation rates. So as that inflation rate comes down, then your interest rates are going to come down.
Got it.
What we did see with that rise is that it did push out some of those lower first-time home buyers,
Right.
priced them out of the market as
Did
far as
it-
qualifying.
Did it double? So if it goes from 3% to 6%, does that double their payments?
No, it doesn't double them, but they do go up, right?
Right,
So that's
right.
a
People think
myth
that.
out
They
there,
think,
right.
hey, I have 3%. Now I'm doing 6%. It's double. So if they had a $1,500 payment, they think it's now going to be a $3,000 payment.
Yeah, no, it's not a dollar for dollar correlation of
Right.
doubling the payment.
Right.
So, obviously, it is more expensive and the buying power goes down, but it didn't double.
Sure.
Right.
Yeah.
That's a great question.
It's good to educate people on that so we don't
Sure.
go, look, it just doubled your payment.
Right.
Right? Because, I mean, you could still buy a house today. In fact, rents are going up and all the landlords are raising their rents this year. You know, we're in January right now. So coming May, everything will be raised. So you may be paying more in rent than what you can do buying your first home. Right? I mean, even if it's a lower, you know, if it's a lower priced home, that's okay. At least, even if it's a townhome or a condo,
Right.
you at least own something that's yours,
Yeah,
right?
Yeah. Instead of when you're paying rent, you're paying somebody's mortgage. It's just not your own, right?
That's right.
Right. You're paying the landlord's mortgage, and you're paying off the piece of property that they own, right?
Yeah.
So why not flip the script on that? And I would tell you too, something I hear quite often is, you know, well, there's a housing bubble or there's going to be a crash, and it's just not true. They're trying to compare today with the interest rates rising with what happened when 2007, 2008 when we had
Right.
a housing
That was an
meltdown.
actual crash.
That was an actual crash.
Right.
Way too many houses and very few buyers.
Mm-hmm.
It's just the opposite right now. There's tons of people. The demand is huge to want to buy. It's just the inventory is low.
Right.
So you will see properties still continue to appreciate even as the rates have risen. You know, property values historically 4%, maybe, let's say, you know. Maybe we're not going to see the 15 or 20% appreciation
Right.
that we saw in the last 2 to 3 years
Exactly.
each year. But still appreciating. The other thing I want to point out is, you know, there's this word about recession, right? Are we in one? Are we
Right.
not? You know, and I think the government has a tendency to try to play politics basically, and redefine when we're in a recession or not, because it's not good for elections. We've been in a recession. Anytime
Sure.
you have 2 quarters of GDP that's receding or declining, that's the official definition of a recession.
Right. Sure.
And we've seen that,
Yep.
right? And so, but now, what most folks the media doesn't tell you, because if it bleeds, it leads in the media. They want that's what sells. What they're not telling you is that typically, if there is an official recession, that home values actually continue to rise during a recession, and they tend to pull the economy out of a recession. The housing market's one of the first things that pulls everybody out of the recession. Does that
Right.
make sense?
Yep.
Yeah.
Totally.
So.
Yeah. And so what's interesting is that people that are wanting to buy a home now, yeah, I mean, today is the day that you buy. I don't care, you know, you don't wait for next week or whatever. Right now, sellers are willing to give, because they hear all the recession stuff and they're afraid that their values are going to come down. This is the time to buy because they're actually going to give you concessions.
Yeah.
They're going to pay your closing costs. I mean, a year or so ago, the buyers were paying all their costs. I mean, it would cost somebody 15, 20 grand in costs.
Just
Now-
in closing costs.
In closing costs.
Not to mention that all the folks that were paying over list price to get the house.
Right,
Right,
exactly. Plus they're paying $50,000 more to get the house.
Right.
Now you can pay full price or a little less, and you can get the seller to pay $20,000 in costs.
Yeah,
right.
We see it all the time with the contracts that are coming in, and that was not the case 6 months ago.
Right,
It just
exactly.
wasn't. Even when they started to rise, rates were rising. We were still, you know, it takes time for the public to switch their mindset, or the consumer to say, or seller, all
Right.
right, yeah, it's not the market we were in. This is a different market, right?
Right, exactly.
The other advantage too, Rob, that I'm sure, you know, if you think about it, there's less buyers because they might be pulling back a little bit. They're a little afraid maybe. So you're not competing with 20, 30, 40 buyers for the same house right now.
Exactly. That's why the sellers are being a little desperate.
Right.
And they're going, oh, no, I can't sell my house. I don't want it to go down 50 grand, so I might as well give up 30 right now.
Right.
I mean, yeah.
Hedge my bets and cut my losses, right, so to speak.
Exactly.
When even then, when we say losses, they're not true losses, because if you look at what they paid for their home and how the equity on that home is just skyrocketed.
Right. It isn't losses. It's just like any stock market type of thing. Stock market goes up and down. You don't lose money until you sell.
Right.
But if you only put in $1 and it's worth 10,000 and you had to sell at 8,000, you still are up money, right?
Correct.
So, I mean, sometimes the seller's like, I lost 2,000. No, you gained $7,999.
Right, right.
Don't look at your loss. Look at your gain, man.
Right.
Exactly.
What's that expression? What is it? About pigs get killed, but hogs get slaughtered, or something like that. Or pigs get fat and hogs get slaughtered.
Right, yeah.
I'm butchering.
Yeah, you're butchering up the saying, but
don't get me greedy.
Exactly. Why? I mean, we're making money. Sellers are making money. And so buyers can capitalize right now on a low, I mean, things aren't going up 20% like you said. I mean, right now it's time to capitalize.
Yep. And most wealth is made in a down market, or even if it's perceived as a down market, right? So that's where you're going to make your long-term wealth, right? And get in now. Like, if you're on the fence, I would say, let us look at the numbers and show you that, hey, we can get you into the home. You're saving on the cost of the house for your closing costs and maybe the purchase price. Maybe the rate is higher.
Right.
Maybe it is.
Right.
But you're not married to the rate. You're married to the house, right?
That's right.
And so, when those rates do come down, you can always refinance when the market dictates that, which it will.
Exactly.
So,
and really, even if a buyer purchases a house now and inflation's not 20%, let's say it's just a natural 3%. I mean, have you ever seen us go backwards in inflation? I mean, it's really traditionally around 3%, right? I mean, at least that's what I've seen in my lifetime. So even if I bought a house now and only got 3%, let's say I bought a $400,000 home, I'm going to get 3% inflation on my home.
Right.
Well, just natural inflation, right?
Correct.
The 20% was unnatural inflation. They're trying to take it down from that and get it back to a manageable inflation rate, right?
Normal market.
A normal market.
Correct.
So 3% of $400,000, what is that? $12,000. So I got $12,000, and I look at a house as being like, that's like your 401k, right?
Sure.
You just gained $12,000, right? So I think that the time to buy is now, right?
Yes, absolutely. Don't be scared, as I say. Don't be
scared. And really, all they have to do is come to you and say, do I qualify for a loan, and how much can I get? Correct. And then you will figure out how much they qualify for. If you say it's $300, $400, $500, $1 million, right? You could say it's $1 million, and then I would say, well, how much do you want to pay per month? Well, I only want to pay $3,000 a month or $2,500 a month or something like that, right? Okay, well, it's not going to be $1 million loan then. Even though you qualify,
right,
we're going to figure out what you're going to be comfortable with.
Correct.
And so that's kind of what we do. Let's talk about loans really quick. There's 3 types of loans. Tell me the 3 types of loans.
Yep. So, well, there's a bunch of them, but let's just, we talk about jumbo, conventional, and government loans, right?
Okay, yeah, sure.
Yeah,
so
categories.
What's the traditional? I mean, people do VA. A lot of military does VA loans. Tell me a little bit about VA. Tell me what the benefits are.
Well, I'm a little biased, right, because I'm a veteran.
That's right.
But in all actuality, it is the best loan program on the planet.
Mm-hmm.
It's a loan that allows a military member, either active duty or a veteran,
mm-hmm.
You earn the right to do a VA loan through your service, mm-hmm. right? It is an earned opportunity that you have, right? Mm-hmm. Because you've made sacrifices. So the government said, you know what? We're going to put this loan program together where you have to put no money down, typically, mm-hmm. right? There's some exceptions to that for people that have more than one property. But, generally speaking, a first-time VA buyer, no money down. And on all the other loan programs, typically when you don't put any money down, you're going to have something called mortgage insurance that's added to your payment, mm-hmm. your monthly payment. The VA doesn't have that. They eliminate that requirement, and it is typically the lower rates in a normal market than what it is on all the other loan types, and the qualifying is much looser and easier to qualify than any of the other loan types out there. And again, it's because of any man or woman that serves in the military, that they are literally trying to put together a program that says, hey, thank you for your service.
Sure.
Right?
Right.
So it's a great program. And what a lot of folks miss out on, or what's crazy, this statistic, more than 80% of military members wait until they get out of service to use their VA loan benefit.
Yes.
Which is crazy. Crazy. Don't wait. Take advantage of it now. And even if you're going to serve 20 years and then get out and retire, you can accumulate homes all over the country and start building a real estate portfolio that will give you true wealth as you approach a retirement.
Absolutely. I literally know multiple people who have been in the military. They come in, they go, hey, I want to buy a house. And we send them to you, and I find out that they have like 4 houses. You know how the old saying for Navy is there's a girl in every port? I mean, military could say, I have a house in every port.
Right.
Literally, a house in every station.
Yes.
And I'm going, oh, you guys are so awesome. You got 4 houses already? They're like, oh, yeah, I got one in Virginia. I got one over there. I got one, and they're all rented out.
Yeah.
And here they are buying another one.
Yeah.
And it's all really because the VA loan allows them to get in for zero down, right? Pretty much zero.
Typically speaking,
okay, $1,000 maybe. I mean, I don't know. Really, hardly anything, right?
Yeah.
Because of their service. And then, when they're there a few years or whatever, they may refinance to a conventional loan or something like that. Then they're getting another one on the next port with a VA loan with hardly anything down, like almost nothing down.
Right.
And then they do that 4 different times. So what your theory of don't wait until you're out of the military. Do it now.
Right.
And keep the property.
Right.
Or sell it and make money.
Yeah, and think about this too. There's some caveats around that, obviously. In
Sure.
Rules, but that, generally speaking, you're right about that. And I would say that, remember, when you're active duty military, you get your housing allowance income that the military gives you.
Yes.
Tax-free.
Yes. They pay for it.
Yeah. So take advantage of that, because don't give it to them to stay on post housing,
Right.
which is way overpriced.
Right.
And you're actually living where you work.
Right.
So you might want to get away from there. And the other piece of that is, when you get to become a civilian again, you're making mortgage payments with your after-tax dollars. So it's a huge advantage.
Yeah.
So and I can do all the calculations and show somebody that, I'll hear, well, I'm going to PCS, I'm not just sure. And I can show them, typically speaking, if they're going to be at the duty assignment for 3 or more years, you should buy.
Yep.
Hands down. And the other thing you touched on earlier, Rob, was that rents continue to rise.
Right.
When you get a mortgage payment on a VA loan, it's a fixed payment, right?
Yep.
It doesn't go up every year.
That's right.
Right.
That's right.
So but your rent does.
Yes. Right.
So most just don't know. And that's one of my missions, is to educate them. I wish that somebody had educated me. I did buy my first house when I came back from Germany and came to stateside, but I didn't know. I put money down. I didn't even have to.
Right.
Yes.
I
could have used that money for something else.
Right.
So
that's funny. Right. You literally have a benefit. You've been serving. You have to put zero down basically. And you're like, oh, I'll put 20 grand out of my pocket. Why? You could have had a 150-inch TV with that money, right?
or invested in something else.
Or you could have invested in the stock market. Exactly.
You know what's funny too, Rob, is I always like to put things in perspective. Like when I came back from Germany and bought my first house, my rate was 8%, and I had great credit.
Yep.
So it did not hinder me from buying a home.
Right.
So don't let these rates scare you. Traditionally speaking, we are still below the average of what, over the last 50 years, what the interest rates have averaged out at. So don't wait. Don't be scared.
Even if it was a townhome or something, like you might be renting a townhome for 2 years while you're here in the military, and renting a townhome or renting an apartment or something like that. So it's not your permanent home. No. So you could buy the townhome and own it, and you're basically, the government's paying down your mortgage, right?
Yeah.
Then you leave, and so it's not like, people think, well, I really would like a house and I don't want to. Well, you're going to be renting an apartment anyway. You're going to be renting a townhome anyway. They don't always rent houses.
Right.
So you might as well buy one of those and have it in your name.
And think about that too. Usually townhomes cost less than a single family resident, generally speaking, not always. And they're easier to rent when you leave too, because
Right.
that rent threshold might be lower than renting a house. Not that should sway you one way or the other, but if you're an enlisted soldier or a sailor or airman, and you're worried about your rank, what you might qualify for, like they buy townhouses all day long.
That's right.
Yeah.
That's right.
And they rent them all day long.
That's right. Exactly.
Yeah.
So let's talk about a little bit about FHA. How is FHA? I mean, explain that program, because a lot of people that are not military, younger in their 20s, first-time home buyers, stuff like that, what can they do?
Yep. Great question. So you got a VA, which is a government loan, but FHA is also a government loan. And so the government also recognizes that, hey, not everybody has 20% to put down on a home.
Right.
And it's not required.
Right.
On an FHA loan, your down payment requirement is 3.5%. So I've seen many, many, many families that when they get a tax refund, they take that money and they put it in as a down payment on a home with an FHA loan.
Right.
The other thing about an FHA loan is that typically you can have lower credit scores. And so whereas on a conventional loan, they want your scores to be a little bit higher because it's conventional. It's the mainstay, right? First-time home buyers love that FHA program because the requirements for what they call debt-to-income ratios. We'll look at like what your debts are that making your monthly payments on credit cards or student loans or car payments, whatever, and add a house payment in there, and we got to see what those ratios are compared to what the government allows. Well, they're higher on FHA loans. They allow for a higher threshold than on a conventional loan.
Right.
So those are the big advantages of an FHA loan if you're not military or don't have prior military service.
So in other words, on a regular conventional, like I would have to go get a conventional loan. I don't qualify for an FHA loan, and they're going to hold down my debt ratios lower than the FHA. The FHA, they can have a lot more debt, and they're still getting them in under the FHA program, which is a government loan, because the government's guaranteeing that loan.
Well, okay, let's talk about that too. So almost that last part where you said they guarantee it. There is a guarantee portion but you pay for it. So remember on the VA loan, there was no mortgage insurance, right? Okay, but on an FHA loan, you have mortgage insurance, and
they're charging you an insurance.
Yes.
It's guaranteed, but not guaranteed because you're paying an insurance that if you default on it, so then they're allowing you to have higher debt to income ratios.
Yes.
You have more debt, and they're like, because you're paying insurance for it.
That's right.
Exactly.
And it's not guaranteed. It just means you have insurance. This is like when you have insurance on your car. Something happens to your car, it's your fault. They're not guaranteeing they're going to pay for it. You're still on the hook, right?
Yes, right.
So you never get what it quite costs to cover it. So that's the same thing with the FHA. It's not as solid as a insurance policy as the VA guarantee.
Right,
so.
But it's fantastic for a first-time home buyer, because a guy like me, you're going to say, Rob, you need to put 20% down. I'm like, 20%? Where did I get that? But FHA, you only have to put 3.5% down. And there may be some other programs even out there that loan you that 3.5% and different things like that, where you can almost get in for zero.
Right. I was going to layer on top of that. So there's some first-time homebuyer programs out there that they'll loan you money basically, or give you money that sits on top of that FHA loan, to maybe at least cover your down payment. And now maybe you're only looking at closing costs, and in this market we're seeing sellers pay closing costs. Right. So great program for a first-time homebuyer, or if you had some hiccups in your credit and it's not exactly pristine, but your scores, say, okay, you're still in that ballpark where we think you're a viable risk to borrow money to buy a home.
Right, exactly.
Yep.
So then the other program would be a conventional loan, where a lot of us fit into because we've already purchased our first home or whatever, and we don't qualify. But let me back up to the FHA really quick.
Sure.
How many years, if I sell my house and I don't own a home for 5 years, can I go FHA again and be a first-time home buyer?
So it's, you can have an FHA home loan as your on a primary residence, not for investment properties, okay?
Right.
But if I sell my home and I'm out shopping for another home, I can use another FHA loan. There's not a waiting period for that as long as you don't have an FHA loan.
Okay, but what about this? I've heard that if I sell my house and I don't own a house, let's say I go overseas for a few years or something like that, I heard there's a number of years that when I come back, I'm literally a first-time home buyer again.
Right. Well, and that's for those down payment assistance programs.
That's for those down payment. Okay.
3 years. It's 3 years.
Okay.
So 3 years, you're not on title for any property, right? Then, and you don't have a loan, then yes, you come back, you can do whatever that scenario was and use an FHA loan again, and you can get the down payment assistance typically as well.
Which
as
is
long
beautiful.
As you qualify and meet their criteria.
Right.
Yep.
So the very best loan was the VA. We're getting in for zero down. The FHA is the next step. You're not serving, but there's so many options for the FHA for them to get in for hardly any money.
Right.
Then we talk about conventional and jumbo.
Yes.
Conventional is a regular loan for a person like me who's already owned a home. And then a jumbo, tell me what that is.
Yep. Well, let's distinguish there's really, for jumbo and for conventional, every county in the country has what they call a conforming loan limit. And the government sets that number. And every year we've seen it go up as the cost of everything goes up, right? And so in El Paso County in Colorado, it's $726,200. So if I borrow that amount of money or below, it's considered a conventional loan.
Okay.
If I go over that loan amount, then it's considered a jumbo loan.
Okay.
So, and jumbo loans have different criteria and different investors that will actually loan that money. They definitely are not flexible on debt-to-income ratios. Like you have to have a certain debt-to-income ratio and you can't go over it.
Right.
Same thing really on conventional, but conventional goes a little bit higher than a jumbo loan on those ratios. We do find that on jumbo loans that sometimes those rates can actually be a little bit better sometimes than a conventional loan, right? It just depends on the market. So talking about conventional loans, don't assume you have to put 20% down on a conventional loan.
Right.
So on a conventional loan, you can go down to 3% down.
Whoa, 3%?
Yes. But remember, anytime you're putting less than 20% down, you're going to have some sort of mortgage insurance.
Mortgage insurance,
So that could increase your monthly payment.
Sure.
But just think about it logically. You're putting less skin in the game to buy the house. So there's more risk to the investor and the lender. So they charge you more on that mortgage insurance. And as you get closer to 20% with a down payment, then that risk is mitigated, and then your mortgage insurance payment starts to decrease as well.
Right.
I've seen options where you can pay the mortgage insurance monthly on your monthly payment. You can do a one-time upfront premium and pay it all up front at once. The lender can pay that all up front for you at once, the premium, but they usually raise the interest rate to cover it. You can do a split mortgage insurance where part of it's finance and part of it you pay. You can do 100% fine. It's just all kinds of options.
So in other words, what you're saying is there's a million ways to skin the cat.
Right.
So let's talk about the difference between a conventional and an FHA. The only real difference that I'm hearing today, because you have mortgage insurance on the FHA, you have mortgage insurance on the conventional, the debt-to-income ratios are different.
Yes. Because remember, conventional is kind of like a plain Jane loan. They're saying you're low risk. You got really good credit, typically a 680 or higher. Doesn't mean you can't go lower than that, but then we got to do some analysis on, okay, if I gave you this conventional loan option and compared to this FHA loan option, which is better for you on monthly payment, right?
Right.
Those sort of things. So we'll look at that. Another difference is an FHA loan typically has that mortgage insurance. You have it for the life of the loan. Unless you refinance the loan, you're going to pay that mortgage insurance for the life of the loan, typically.
Okay.
All right?
Yep.
On a conventional loan, as you're paying down your mortgage balance, and maybe let's say you put 5% down, as you pay that loan balance down, it'll automatically, that mortgage insurance on your monthly payment will fall off when you hit 78% loan to value.
Wow.
Automatically. So that's a big difference.
So if I've been paying for my FHA loan for 20 years, my house is worth hundreds of thousands of dollars more, I'm screwing myself. Really.
Oh, yeah.
You're so really once you get that FHA loan, within so many years, you should be refinancing if it's reasonable. If you have a 2% rate and you have to refinance to a 10, that wouldn't be reasonable. But really, people can be stuck in that FHA for a long time and be paying more than what they should be paying. Whereas a conventional, you can put 3% down. As long as you have lower debt, you get into that. You still have some mortgage insurance, but that will fall off down the road naturally.
Naturally, without you having to do anything other than make your mortgage payments.
Exactly.
Right. And you touched on something I was going to tell you on that FHA loan. When we talk about refinancing, don't assume that it's just interest rate based. Okay.
Mm-hmm. Okay.
Life happens.
Yes.
As you're paying down your loan balance, and you don't do anything else except make your minimum payments. Mm-hmm. You're paying down the balance, and remember, naturally, there's a small increase in the value of your home, right? Like you said, with inflation, generally with inflation, right? And so that gap gets wider and wider, and it's like a forced savings account. Well, sometimes you may need to send a kid to college. Right. You may need to pay for something that came up, medical expenses, whatever they are. And there is an opportunity to tap into that equity that you've built in your home, where it may dictate that you really do need to get a refinance, not just necessarily because the rate is lower.
Right, I got you. Yeah. Okay, yes,
yeah. Just
you're tapping. It's almost like you're taking a little bit from your 401k.
Right, exactly.
Right. I just need a little bit. Yeah,
that's
right. Exactly.
Yes.
So I get it. Because even if you take some from your 401k, you have to pay it back.
Right.
Exactly.
You're paying yourself back.
So you're taking you're paying yourself back. Exactly.
Right. That's exactly right.
Plus the interest. Yeah.
Yep.
So, okay, well, let's talk about one other thing I want to ask you. How much can a seller pay of my closing costs? Like, if I ask for, if I got a $200,000 loan and ask them for $50,000, can I do that? I mean, what can I ask them to do?
Yeah, that's a great question. So it really is dependent upon the type of loan you're doing. Mm-hmm. And there are limits to what sellers can give in concessions. Okay. I think the loosest requirement, again, going back to that VA loan, there's a misconception out there that someone can only pay up to 4% in concessions on that loan. Well, that's not true.
Okay.
You can actually go over that. It depends on, is it in a concession bucket? And when I say that, that just means in the VA lender's handbook, it lists certain loan costs that they put in one bucket, and then there's other ones that are in another bucket.
Okay.
Oh, and by the way, I didn't mention this earlier. Seller concessions from a seller for a VA buyer, they can actually pay down some of the debts that the veteran has for qualifying for the loan.
So a seller could pay off my credit card?
They can, yes.
Wow.
Yeah. And so, which you can't do on all the other loan programs. VA allows that.
VA, whoa.
It's just an awesome program.
That's awesome.
Yep. And then, on a conventional loan, there's a cap based on how much money you're putting down. What's the loan to value? Like the value of the house versus how much your loan amount is. You divide those two, and whatever that loan to value is, that will determine how much you can go get in concessions from the seller.
Right.
Yeah. So, and the more you're putting down on the house, the more concessions you can get on a conventional. I think it caps out at, and don't quote me on this, I always go back to the handbook, but I think it's 9% on conventional. So
wow.
Yeah,
okay.
Yeah. Yep. And then FHA has limits as well too. So,
what's interesting, you said a bucket, right?
Yes.
So that kind of, it's like it's a play on words. Here's your concession bucket, and here's your other bucket, right? Mm-hmm. So what you're telling me is when people say, hey, there's only a 4%, you can only pay up to 4% in concessions, it's like, well, wait a minute, hold on. There's multiple ways to skin the cat. Again, right? If I need $20,000 for things, you're going to go, well, this is this bucket, and this is this bucket, and you can get more.
You can, and it's, again, the most lenient is VA.
Yes.
And there's many folks that claim to be VA loan experts that are not, because you often hear someone will tell you the cap is 4%. It's not true.
Okay.
Not true.
Wow.
So just.
But you said up to 9% on
conventional.
On a conventional. That's huge.
Yeah,
That's huge.
If somebody's putting a big down payment, yeah, absolutely. So So anyway, when in doubt, I always refer back to the handbook and the lender guidelines because they change.
Yes.
But generally speaking, yeah, it's on the loan type, how much you can do. Please make sure that don't take on the surface that what someone's telling you, because they may be thinking back, time and guidelines change. Like they could be thinking 2 or 3 years
Sure.
ago because they haven't looked.
Yes.
You always got to look because they change all the time. So,
Right.
Yeah. And if you ever want a second opinion, don't be shy. Even if I'm not your lender, call me. I'll tell you.
Sure.
Rob calls me because, every now and then he'll get someone who's just like, they're a diehard. I'm working with this person.
Yep.
And he'll call me to double check. Right.
Yes. Right. That's right.
So just know that, I'm always happy to answer questions.
Well, speaking of, to kind of wrap up things, tell us, how do we contact you? Your number? Do you have a website? Like if we want to apply for a loan or something like that, where do we go?
Yeah. The best way is I give my cell phone out to everybody.
Okay.
So it's 719-229-0375.
Okay.
Call me. My wife and I know that people like to buy houses nights and weekends.
Sure.
So I answer my phone, and unless I'm on the phone serving a family.
Mm-hmm.
So just leave me a message. I always call back, and I want to be the first one to talk to you, even though I have a team of folks that support us through
Right.
that process and
Right.
help hold your hand the entire way.
Sure.
No matter what level you're on the scale, if you're a first-time home buyer, you're buying a jumbo, doing a jumbo loan, and you've got real estate everywhere.
Right.
And then, of course, our website is very easy. It's applywithrick.com.
Applywithrick.com.
Super easy.
So literally, if somebody's listening to this podcast right now and they're like, you know what, I think I want to ask Rick what I can be approved for or pre-approved for, they just go to applywithrick.com. And what are they going to find when they go there?
Yeah. So, there's a lot of stuff there, but ultimately, do an application.
It's an application online.
Yep.
Secured.
Secure.
Beautiful.
Create their own account and answer some simple questions. Typically on an application, it's 2-year work history, 2-year living history, any assets you might have, some yes/no questions, and that's it.
Beautiful.
That's it.
And then you can get back to them, say, hey, I think we can qualify you up to X amount. And then they can call me and we'll see what's out there.
That's exactly right.
Right?
Don't assume anything because you just don't know. We're seeing purchases in the 200,000s in Colorado Springs and Pueblo, and then we're seeing, it's a wide open market right now. I think you don't know until you know.
Right.
So
awesome. Well, anything else you want to add?
I think that's it. I think we take great pride in serving those who serve, and I know I've talked a lot about veterans, but we're also really big in our first responder community. So they serve as well too, and we don't want to overlook them because let's face it, that's a dangerous job these days,
Yes,
even
sure.
more so than ever. And
Yes.
they deserve our respect, and we do use our platform as a way to say thank you to those that are serving both in the military and first responders. So I just want to end with that, and
Awesome.
appreciate you having me on
Beautiful.
the show, Rob.
Thank you, Rick, for being with us today.
Yep.
And you guys call Rick, go to his website and get pre-approved. And then when you're done, we'll find something for you. Have a great day.
Take care.